Florida?
Florida real estate's been in the news more than any other state, I think, over the past, let's say, 6 months.
Yeah.
During the beginning of the pandemic, the only headlines you saw, first it was New York and California, how everybody was leaving the states, and then that exacerbated as the lockdowns continued.
Yeah.
And you saw that before COVID, New York City had a 5% vacancy rate, and then went all the way up to 30%.
Yeah.
In Manhattan specifically. And so you saw a mass migration out into places like Texas and Florida.
Yeah.
And other southern places, Charleston, South Carolina, Nashville, Tennessee. But since then, now that we're post-COVID, it seems that Texas is still a dominant force in real estate, obviously. It's the second biggest real estate market right now. It's a huge growth and huge demand. Florida seems to be the headlines, though. Everybody's forgotten about New York. California is always going to be in the news for political reasons. But as far as real estate concerns, even with the Palisades fire, that is kind of, it went up again in news topics with the insurance crisis that's happening over there, but then it totally faded out. Florida, though, consistently is on everybody's social media pages. We went viral for a video about Florida. Then you, on X, through no searching or anything, your algorithm, which is completely tailored to something utterly different, brought up a chart, which we can include in here, of the Miami, I think, was it the housing supply? Is that what it was?
Yes. Sales are down from the 50% from pandemic peak and are 30% below the long-term average from March. Mm-hmm. So, yeah, there's a collapse in demand and an overabundance of supply.
What was the statistic about the highest level since 2012? Didn't I see that right?
Yeah. Inventory levels are the highest since 2012. So Miami's has a vast amount of inventory with 50% less demand since the COVID.
Right. The question is how much of that is condos and how much of that is single-family residences? Because the feedback that we've been consistently receiving is that Florida's single-family properties are still in demand and are still selling pretty quickly, that the majority of the quote-unquote housing bubble is affecting specifically the condo market, which would be in line with everything that we've seen since the Surfside condo collapse and the rise of insurance costs, HOA dues, that they're the ones who are getting the most affected by this.
Yeah. I mean, they have the statistic that, Florida as a state, the insurance premiums have doubled in the past 2 years, with an average exceeding $6,000.
And that's just the average too. We have
national average is $1,700 too, to show you how high that is.
Right. And so there's a lot of reasons for that. We suffer from the insurance crisis as well in Louisiana. Well, when you say Louisiana, North Louisiana, Shreveport's doing just fine.
Monroe.
Yeah, they're not worried about that. They're not worried about hurricanes. By the time, even if it's a Category 5, by the time something gets to them, it still may cause a little ruckus, but that thing's completely dissipated by that point.
Yeah, disarmed.
Right. Where we are in the coastal area, southeast Louisiana, around New Orleans, I remember when I first started to get into the business, I was doing a lot of deals in Slidell, which there's a bunch of waterfront communities over there. It's about, say, 15 miles from inner city New Orleans. Mm-hmm. But the difference is that the reason why New Orleans has historically been spared, Katrina is a totally different story, but New Orleans has had several major hurricanes come through over the last 100 years, but it's been spared from receiving the brunt of the devastation because of Louisiana's vast coastline and the the hundreds of miles of barrier islands and marshland that would break up the hurricane. As the hurricane is going over open water, that's how it gathers strength. The minute that it touches land, it doesn't have any power to draw from, and so it starts to go down. Mm-hmm. Now, those coastlines are starting to evaporate. Every time a hurricane comes through, they recede further and further, and at the same time, a place like Gulfport, Mississippi, or Pascagoula, Mississippi, where Hurricane Katrina directly hit, they're consistently getting the full brunt because they don't have anything to break it up. Slidell is another example of that. Mm-hmm. Whereas New Orleans has the barrier islands and the coastline, Slidell does not. It's directly open to Lake Bourne, which directly opens to the Gulf of Mexico. When I first started to do business out there, it was I would say in 2021 is when the writing on the wall started to appear about how bad insurance was going to be, and what we're still at today, and now it's worse than ever. I remember I had somebody who was selling their house. No, they were buying the house, and they were getting a quote for homeowners insurance. The previous owner had paid $1,700 a year, which is right in line with the national average. They got quoted for $4,500, which is a drastic leap. That's almost 3 times as much money as they would be paying a year. And those have continued to go up since then, because the more storms that hit anywhere in the Gulf of Mexico, it's, State Farm's across the entire Gulf. If a major hurricane hits Alabama, it's still going to impact Louisiana. It's still going to impact Miami, because these are the same companies that are assessing risk in all of these areas, and they're for profit. So they're going to be jacking up the premiums. At the same time, the cost, I had this statistic, I'll have to look this up later, but not only are the hurricanes becoming, it seems to, or maybe we're just in a spell right now where we're seeing a lot more frequently these high impact, category 3 and above hurricanes hitting the Gulf of Mexico, but the cost of the damage that they're reaping upon these areas has exponentially grown. And you could say that's for various reasons. Well, property values have continued to go up. Inflation has continued to go up. But these companies have been continuously paying more and more. I mean, hundreds and hundreds and hundreds of billions of dollars each time one of these things comes through.
Yeah, it's almost like a disaster. Just like a big, chaotic disaster.
Yeah, I don't see a clear way out of it.
Like California, okay, suffers from the fires. They could easily develop a better water mechanism to put out these fires.
Or just
quicker response. Them. Yeah, quicker response as soon as they see it starting to happen. Mm-hmm. More water supplies. They can figure that out.
Yeah.
Can't figure out hurricanes.
No. What the insurance companies are going to do, the main concern is homeowners insurance. Flood insurance is a whole different disaster that eventually will become a big problem, but right now we're still okay because the premiums, because they're federally regulated, the federal government, FEMA, is who you go to obtain flood insurance. They have instituted a program that they've essentially reassessed all of coastal America in flood areas. And they've enacted new effective premiums that eventually these properties will have to pay.
Yeah.
But the premium can only increase by 16% a year. So there's a bunch of areas where you'd be paying, $850 a year, and then you get a letter from FEMA saying the effective premium is $6,500 a year. But it doesn't jump like that overnight. It's year by year. That's why it's so important to assume the flood insurance policy, because that discount, if you want to say, can be transferred to the new owner. Flood insurance is transferable. Homeowners insurance is not. And so if you didn't get that flood insurance policy transferred, then the new owner would have to, their rate would jump up to the new premium.
Mm. What do you think about, reading this comment that someone was talking about insurance? This is Sting Fan 101. She said, please highlight the fact that insurance is not an independent necessity. It is directly tied to one's credit and their overall risk factors as a whole. What do you think of that?
Like that's kind of confusing. What I would say this person's trying to get at, if you have a mortgage on your house or a condo, if a bank or a lender is giving you the money to buy it, they don't hold the deed. It depends on the state, but they hold the promissory note that they could put a lien on your house. The mortgage is backed by your property. So if you don't pay the note and you eventually go to foreclosure, the bank can make you sell it so that they can recoup their money. That's why they charge interest, is because they're obviously in it for profit, and they're trying to make money off of the loan that they've guaranteed. And so
can insurance be higher though if you have lower credit? or is that not even?
I don't know about that. I don't know. But basically what the risk is for a lender, if they've loaned you $400,000 on a house and a hurricane comes and blows it down, then they have nothing to collect that money. Mm-hmm. Even if they're going to come after you and make you pay, there's no way for them to collect it. They can't go to your other assets like a tax lien could. It's directly tied to the property. So they force you to have insurance. If you own a house outright, then sure, you don't need to have homeowners insurance, but that's kind of the big risk, is that if you do live in one of these coastal areas and you're in a high risk zone, going back to Slidell, I saw the writing on the wall, and this one day will probably happen. It's probably going to happen in a lot of these areas along the coast, that you're going to have people who bought 15 years ago and are retired, and they paid off their house, and they bought it for $110,000. Now it's worth $600,000. Well, to insure a $600,000 house in some of these high risk areas, that's basically like paying another mortgage note every year. So they're going to say, well, I'm not going to pay it.
Yeah.
Because if my premium, for me to recuperate the value of my house by my premium, I would have to carry the homeowner's insurance for like 20 or 30 years before I would pay them as much money as my house is worth. So I'm going to take that risk. But I think that you're going to see a lot of people who are going to self-insure, and then one of these hurricanes is going to come. They're going to lose everything.
Lose it all, yeah.
There's nothing to back it up at that point. The money's just gone.
Unless they just don't care. But look at this. This is interesting right here. Insurance can be significantly higher if you have a lower credit score. Homeowners with poor credit pay an average of 77% more for home insurance than those with excellent credit in most states, including Florida.
Interesting.
For example, a person with good credit might pay $2,100 per year, while someone with poor credit would pay $3,600 per year, a difference of 71%. Insurance companies use credit-based insurance score, which is derived from your credit history. The use of credit as a factor in setting insurance rates is allowed in Florida in most states, though a few states like California prohibit and restrict it.
Interesting.
So it's actually banned in California to give you a higher insurance rate based off your credit, whereas in Florida it's legal. So yeah, if you do have a lower credit score in Florida, you're going to pay even more insurance of the already high insurance that they're charging.
I don't know how I feel about that, because these are private companies that are writing this, and obviously that doesn't mean that they can't be regulated, but that's interesting, because in a place like California, then these companies would be forced to give more affordable policies to people who are more at risk of losing in the long run.
Yeah, but they're insuring. See, I actually think that California is right on that, because what the insurance companies are insuring is natural disasters and or fires.
Not only that, homeowners insurance applies to a lot of things. Obviously, that's the biggest risk, is a total loss.
Well, it's the biggest risk, and that has nothing to do with your credit. A poor person's...
I've seen so many people who, a pipe busts in their house and it seeps through their walls. There's also deferred maintenance that could be involved in that too. And that's why I would assume that's why they would give a higher premium to somebody that they would deem to be a higher risk, is that they wouldn't be keeping up with the general maintenance of their property, which could lead to a much more costly repair.
Well, I don't know, though, because if a pipe burst, and this is a good conversation. If a pipe burst or their house catches on fire, you're not going to not do something about that. I mean, that's like a drastic, like, hey, my house just burnt down, or half my house just caught on fire. Or, hey...
No, but that's not the point that I'm making, though. It's deferred maintenance. That's the thing. It's something that could have been prevented.
A pipe burst or a house catching on fire, I don't see how that would be deferred maintenance.
Maintaining the roof. That's an example of deferred maintenance.
Yeah, but...
a windstorm comes through and there's loose shingles, and you haven't nailed them back down, and then that leads to a leak in the roof, which then goes through the walls.
No, but anytime something like that happens, the insurance companies investigate, find that, and no matter if your credit's good or bad, they say, hey, you didn't do proper deferred maintenance, so we're not going to pay, basically. No, if there's deferred maintenance, whether your credit be good or bad, the insurance company's going to investigate, find that there was deferred maintenance. I mean, I can't tell you how many times I've heard insurance companies knock people who I know have excellent credit score for deferred maintenance and say, hey, we're not giving you a dime of money. So yeah, they're going to investigate and find deferred maintenance, whether you have high credit or low credit. For me, it's about, the sudden disasters like fires, sudden pipe bursts, sudden things that the insurance companies are supposed to cover that no matter what, because there's nothing you could have done to prevent a pipe bursting, or say a lightning strikes your home and it catches on fire, or, a kid next door drops a match and it catches on fire.
Well, sure, but that's not what I'm saying, though. There are certain things that if the average residential property depreciates by over the course of 29 years. So if you bought a new construction 29 years later, if you did nothing to it, if you never improved anything, then it would be effectively worth zero for tax purposes, at least.
Yeah.
So going with that logic, there are, and I think the statistic is you want to have at least 10% of the property's worth in your own private cash reserves to reinvest into the property each year to keep it up to that maximum level, that proper level that it needs to be in to function properly. There are many things that people just don't do that could lead to a bigger problem down the road. One thing that they do, I'll give you an example. I've heard talk, and I'm sure this is the same across the coast, of governments stepping in to try and figure out a way to lower premiums for homeowners, is having basically a much more, what's the word, in-depth process of analyzing each property individually and writing the policy based on the structure itself, kind of like an appraisal or an inspection. There in Louisiana, I've heard talks of there's okay, so when you apply for insurance, there's a big checklist that they go down. For example, one of them is there's outdated electric panels, okay, that were known in the 80s or 90s to catch on fire. Building codes have since updated, but if you haven't updated your house since then, if you bought in the 80s or 90s and just had one of these panels, it's more at risk to have a fire breakout.
Yeah, but an insurance company is going to knock people with good credit score or bad credit score if they don't have updated panels, no matter what it is.
But their argument would be that somebody with worse credit would be less likely to improve that.
But they don't write it based off of what someone might do. They write it off of what someone has and has done.
Which is their credit history.
No, they go, okay, well, if you're not going to update your electric panels, no matter what your credit score is, we're going to charge you.
You would just get outright denied.
Yeah.
But there's a form that you fill out, or your insurance rep will fill out.
Or they charge you a higher rate, no matter if you have good credit or bad credit.
Sure.
I'm saying generally...
What they're proposing, though, what I'm saying is that they're trying to implement a much more elaborate, much longer insurance form that goes in much greater detail about the condition of your home.
Yeah.
That each box that you would check off, if it's in line with what they want, would lower your premium.
Yeah, but that's for the problem, though, with this that I see is that checklist can be for someone who has low credit or good credit. And a person with low credit can change. That doesn't mean that they don't have money just because you have low credit. They could easily change the electrical outlets too and stuff like that and get it up to code to what the insurance wants. What I'm saying is purely charging more just because you have low credit. Let's say the low credit person has updated all the electrical appliances. Let's say the bad credit person has done the deferred maintenance on the roof to make sure all the shingles are nailed down, have presented evidence, look, I've done everything, but the insurance company says, just because you have a low credit, I'm going to charge you more money.
Let's see if we can find out why then. What is the valid reason behind that? Is it just usury, or is there something else behind it?
It's insurance companies.
Here it is. Studies and industry data have shown that people with lower credit-based insurance scores tend to file more claims and cost insurers more in payouts than those with higher scores. For example, a person with poor credit may pay up to, we just read that, 70% more for homeowners insurance. Predictive value. Insurers believe that how you manage your finances, e.g., paying bills on time, maintaining low debt, is a reliable indicator of how likely you are to maintain your home and avoid filing claims. That's what I'm saying. That is what they're arguing, though.
If you look at it, though, from a purely logic perspective, just, Thomas Paine common sense perspective.
Yes.
What deferred maintenance can you do to pipes in your walls?
Big time. Big time. I'll tell you one that we have on a pretty consistent basis here is in the 90s, they were switching to PVC and different forms of piping. Now, PVC is the gold standard for the piping that's actually in your walls. The main might be something different, but that's a different story.
Okay.
Polybutylene piping is it really in northern states where you have hard freezes on a consistent basis, we're known to burst. The material is fragile. Water naturally erodes the inner lining of the pipe. And so they would make the claim that if you were somebody who bought in the 90s and have been there for 20 years or whatever, and have known polybutylene piping in your house, if you have poorer finances, you are less likely to take out the major repair to change all of the plumbing in your house
over to
PVC piping.
The insurance companies could simply ask the person with good credit or bad credit, do you have this kind of piping in your house?
No, they can do that.
Yes or no?
No, they can do that. But that's what I'm saying. That's the argument they're making, is that somebody with higher credit would be more likely to make those repairs and the deferred maintenance rather than letting a problem occur and then filing a claim on it.
I don't believe that, no. Because if the insurance company says, hey, bad credit person, do you have this kind of piping in your house? Yeah. Okay, well, that's more likely to burst. So I'm going to charge you higher insurance if you don't get this done.
But
what evidence?
But
yeah,
these when you get an insurance policy, you go through the, I don't know what you call it, the underwriting process or whatever it is, where you fill out that piece of paper. However, if you already have it, if you own your home, and when it's time to renew, they're not going to make you fill out that whole questionnaire again. They just up the premium to whatever the new effective premium is. You don't go through that process over and over and over again. You would, though, if you were to switch.
What about, though? Okay, no. This is a pure common sense thing. What if, assume the bad credit person has the most pristine piping, the most pristine electrical outlets. They bought a home that's got the best outlets, the best piping. There's nothing inherently wrong with anything with their house except that they have a bad credit and they're charging them more purely off of bad credit. Let's go to the fire example. If a kid is playing with matches and accidentally sets half your house on fire, that's not going to be based off of whether you have good credit or bad credit.
Sure. I'm
saying that charging higher premium purely based on your credit score I think that's wrong. Yeah, because I'm fighting for the underdog. That's that's a very clear sign of corruption to me, and I could see exactly why California would actually forbid that. Because to me, that's a clear case of the insurance companies, the big powerful insurance companies, taking advantage of less powerful individuals.
Perhaps it is. Yeah. What if they have specific data that they could point to backing up their claims that people with lower credit typically file more claims and have higher payouts than those with higher credit? Does that change the narrative at all? Because this is a private company. We're dealing with national companies. Yes, they're big corporate, capital C, but at the same time, they're in it for profit. And so if they have 50 years of data pointing to a direct correlation to lower credit and more claims and higher payouts, and you were Mr. CEO of State Farm who has this brought to his table, like, what do we do about this? We're losing money. We're bleeding here. How do we fix this? Okay, well, then a natural solution would be just to charge them a little bit more money every year.
Well, to me, it's almost like, say a kid's playing with matches, lights, part of your wall gets scorched. It is an insurance claim, clearly, because you weren't playing with matches. Some kid lit a wall of your house on fire. Yeah,
but this is the problem.
Wait, let me finish.
This is anecdotal, though.
Yeah, but the rich.
I see what you're saying, but they're making these policies based on, I mean, how many homes in America? How many homeowners in America?
Yeah, maybe
160 million.
I would argue, maybe the lower credit people actually need the insurance company to actually pay what they said they would do versus some richer, higher credit person might just be like, it's only $5,000. I'll just chuck it up myself and not care about it.
Well, right, but that's taking the mindset though that these insurance companies like have a That's taking the mindset that these insurance companies have like almost a charitable obligation to the community rather than that they're a private company.
No, I think
that's a for-profit company with shareholders.
I think it's the same thing of what everyone gets angry about insurance companies about is they have to play by their own rule set. They have to pay if a certain criteria is met. A clear evidence criteria of, hey, I had the fancy outlets that are supposed to cut off whenever, a short circuit happens, but
GFCI.
mine still caught on fire and burned this down. It's like if it's clear rules, the insurance companies pay. I mean, how many stories have we heard of the insurance companies not wanting to pay for Hurricane Katrina victims and stuff like that?
Oh, yeah. Well,
and
Ida.
skimping
most recently,
around that.
Yeah. I had people who 2 years later still had a tarp on their roof.
Yeah. So, no, I completely agree with California banning that. I think that keeps the insurance companies in check. Hey, you need to spell out clear rules and regulations of what you're going to pay and not pay. Make sure you have clear guidelines for what you're going to pay for and not pay. If the person doesn't have the GFIC outlets or whatever you call them, charge more. If they do, though, and something does happen, you have to pay. There's no getting around it. There's no, I would say that that's a form of usury, of taking advantage of lesser people with less blessed means purely for the sake that they're less blessed.
I think that it's more nuanced than this. I'm not a defender of the insurance
companies.
companies.
People would hate you if you're like a defender of the insurance companies. Like people would come after you.
No, they're
like, oh wait, you're a defender of the insurance companies.
No, but what I'm trying to view it from a nuanced perspective. Obviously, I want to pay less in homeowners insurance. I think that from an emotional level, I think that it's not the most ethical. Or let's even zoom back. It's not the most Christian form.
It's entirely unethical, I think.
Sure.
If it's purely the credit and nothing else.
For sure.
Yes. Like if they have good roof, they have good outlets, they have good pipes, and the only other factor besides that is that their credit's worse and you're going to charge them more because their credit's worse. I think that is entirely unethical.
Right, but is that how it actually is? Or is it actually that there is industry data pointing to that people with lower credit file more claims and have higher payouts than those without?
Okay, from a personal level.
But because what is the actual reason of that? How does that apply? I understand what you're saying, that if you have a perfectly good house and you have poor credit and there's nothing besides that would give you a higher premium and your house burns down and they're less likely to give you your full coverage because of that, then that's obviously wrong. And I'm sure that applies, and that's why people hate insurance companies, is because they're not getting paid.
Yeah.
But the thing that's underwritten by all of this, though, is that the public is probably not as properly informed as they need to be with all of this. But at the end of the day, you're damned if you do, you're damned if you don't, because you as the home buyer, caveat emptor, buyer beware, you're the one who, when you are agreeing to buy a home or you're going to a mortgage company, you're getting a loan and they're requiring you to have insurance and you're talking to the insurance rep and you're getting all of that underwritten, you are the one who is ultimately agreeing to this. And that I think that the burden is on the home buyer to understand exactly what they are getting into when they're doing this. And obviously they're not.
Well, no, I think it is willful ignorance on the behalf of the insurance companies to not clearly lay out the rules and regulations.
I totally agree with that too. I totally agree with that too.
In the sense that it's like this, and they do this on purpose so they can get away with murder in a sense where, okay, you want homeowners to have GFIC outlets. You want homeowners to have this specific piping in their walls. Okay, we'll make sure that they prove that, and you can charge more if they don't. But I think they turn the blind eye, and that's why the government's making them, you said, starting to have these checklists.
Well, they're trying.
Yeah.
Nothing's been done yet.
Well, that's a clear sign to me that the insurance companies, and even from personal experience, I've only had personal experience of insurance companies that have willfully tacked on unnecessary charges on things using my ignorance of not knowing what car insurance even, like the uninsured motorist thing, how your comprehensive actually covers if someone doesn't have insurance and they hit you, but then also tacking you on with an uninsured motorist charge because they prey upon the ignorance of the person getting insurance. And so I feel like they willfully, purposefully don't clearly lay out their rules and regulations and how they assess risk so they can slip in some extra money by taking advantage of people.
I'm sure they do.
Yeah.
I'm sure that's true.
Yeah. Which is, I would put the burden on the insurance companies. I think it's like, hey, you want to...
I agree with that too, but I also think that nobody's innocent at the end of the day.
Yeah.
I think that, these people are definitely not innocent. These big C corporate entities who are writing these policies definitely should be held more liable for what they're doing. And they should be responsible. And I think that there should be more clearly spelled out guidelines to how these things work in plain English, not legal jargon. That just is nothing. You're on a piece of paper like, what the hell is this? But also at the end of the day, I do think that a good portion of the burden is on the homeowner as well, that they need to understand these things before they buy a house.
Yeah. I would see, I would put the burden more on the insurance companies because
I'm not saying where I'm drawing the line, but
how is a
homeowner
going to be able to read legal jargon and things like that and understand without the insurance companies clearly laying out proper rules and regulations? There is a responsibility of the homeowner, but let's just say the insurance company is not your friend in a sense, but
well, yeah, of course they're not your friend.
Yeah. But that's, we can go, if you want to look at I think we tack that high enough. You're a defender of the insurance companies. I'm a defender of the people.
Well, no, I think because the whole thing is, say John's doing well in his business. John does well enough to where he has somebody approach him from State Farm.
Yeah.
He says, John, I want you, I'm going to offer you an opportunity to be a shareholder in State Farm. If you agree to come onto the board, because we've seen you're just so brilliant in managing your own business and assets, that we want to bring you in. We're going to give you we're going to give you a lot of equity in the company. We're going to give you a great stipend. We're going to give you a retirement package, benefits, the whole nine. And then you're brought on to do this as well. If you're looking at it, because this is the thing, we need to separate these companies. They are not a public service. Just like you said, they're not your friend. They're a company. They're for profit. Their goal is to make money at the end of the day. And so as a company operating with a responsibility not to the homeowners outside of what's in their contract, but to their company, to their shareholders, they are going to act in their best interest. They are not going to act in the homeowner's best interest. Why would they? When you're entering into a contract, when you're negotiating with somebody.
I think they should act in the homeowner's best interest as long as the rules are clearly laid out.
As long as that interest is clearly spelled out in the document that the homeowner is signing.
Yes.
But at the end of the day, they are a private company. They are going to do what is best for them as well.
Which is take advantage of people? Or
I'm not saying it should be more fair and honest and clear and everything.
Look at every single insurance holder's commercials. We're here to protect you.
Yeah, it's all bullshit, of course. And
help you and serve you and make sure you're safe, basically.
Yeah.
Well, let's say, generally,
they're there to make money.
If I'm an insurance company, though, besides obviously you want to make money, but obviously you want to have hey, I actually do want to, if someone's house burns down, be there. There is a ethical higher calling for running a company like that. Like, hey, I actually do want to help people that suffer disaster. And not everyone's house is going to burn down.
Yeah, I just don't think that exists. I don't think that exists. I think that's giving too much credit. There's, the little expression, give the devil his due.
Yeah.
It's know the devil. Know what he wants. Know what he does.
So you're saying the insurance companies are the devil?
Well, no, not in a sense. I'm saying that they have their own interests at heart, just as anybody does in any negotiation.
Yeah, sure. And so do
I'm not saying that that's the ethical thing to do, but they are private companies. That is the effect of a totally open and free market. And so it is laissez-faire. Hey, if you're willing to sign on the contract, we are too, buddy. Let's go. Yeah, $6,000 a year.
Put Coke in the Coca-Cola.
No, here's what
meth in the baby rattlers.
Here's what the bigger problem is. That is an important conversation, but I don't think that is not the bigger dilemma what these coastal areas are facing. I'm not underwriting that.
Let's say this though is I think the individual homeowners also have their own interest in things to protect their own interests, and sometimes somebody more powerful than the insurance companies. Say if I was president of the United States, hey, I want to protect the people. My interest is actually protecting individuals and real people.
Ooh,
so I'm going to crack the insurance companies.
It's this. The only way to really do that is for more regulation on these companies. But when you have corporate lobbyists who are appointing people and helping fund the campaigns of people that are in these higher risk areas that may be campaigning on the promise to rewrite the whole system, and then they get in there and they don't have anything, and then these other lobbyists are getting involved too. I think that the bigger responsibility is on the local, state, and federal communities to make sure that they're representing their people.
Yeah.
Rather than the interest of these companies. Because here's the big thing. Wait. Yeah. Here's the big thing. This is where the real jacking up of the rates is coming from, is that because these are for-profit entities, if they're running the numbers and they're seeing, well, hell, New Orleans over the past 20 years, this is how much we've made from the entire area. Here's how much we've paid from the entire area. If those numbers don't match, well, then we got to make something work to where we're still in the green here. Same thing in Mississippi, same thing in Texas, same thing in Florida, same thing in all these high-risk areas. And if those numbers don't make sense and they're projected to go up, then most of these companies are just leaving the state.
Yeah.
There's no competition to where the people who are remaining are able to do whatever they want. They essentially have a monopoly over the entire region, and that's where these huge increases are coming from.
Hurricanes are different than credit score. And I think, California did an excellent job, like you said, by protecting their people's interests by banning raising insurance just based off of credit score.
Sure, and that's an important point. I think we covered that. But the reason why there's an insurance crisis is not because of people with lower credit getting charged more. The reason there's an insurance crisis is because regardless of who you are, if you're buying within 30 miles of a coastline, you're paying another mortgage note in insurance costs.
Well, it's like a double dip, though. If credit makes your insurance go up in Florida and the hurricanes and the this, that, and the other, it's like, your insurance is just like sky.
Yes.
In the sky.
I saw the highest one that I've seen was in New Orleans on the other side of the Mississippi in Algiers Point. And there was a property that got quoted for $25,000 a year in insurance. $25,000. It was I want to say it was a $700,000 house. We see that all the time, though.
That's insane.
In the luxury market, when you're looking at obviously these people are slightly different in their effect, but if you're looking at a $2.5 million home, it's completely normalized at this point to be paying $20,000. We saw $40,000 for one of the houses that we sold this year.
Yeah, crazy. And then the last point I'd like to touch, I guess, before we end it is Florida's net domestic migration dropped from 314,000 plus in 2022 to just 64,000 in 2025. That's a very drastic drop in people.
Wait, 65,000?
64,000 in 2025 from 314,000 in 2022.
Right, but we're only a third of the way done, or a fourth of the way done the year.
Maybe it was 2024.
Okay. Well, that's very different.
Yeah, I mean, that's a drastic drop in people migrating to Florida. And a lot of people have said that a lot of areas have so much people in Florida now that it's like all the highways are jammed up and there's a lot of traffic.
Oh my God, I just went there. The traffic to travel, 12 miles, to go from Orange Beach to Pensacola takes an hour and 15 minutes.
Yeah.
It's ridiculous. It's 12 miles away.
Yeah, that's insane.
But
that's like Mandeville after Hurricane Katrina, all the people flocking to Mandeville.
And so it's
Northshore.
Underbuilt.
Yeah.
Or underdeveloped. Overbuilt and underdeveloped. What was the year of peak migration?
Probably like 2021, 2022. Yeah.
Yeah. So the reason that you saw such a boom in specifically southern states at that time was because it was a direct result of the lockdowns that were being implemented. There was this awakening, and especially the same thing with the boom of the suburbs, people leaving urban areas and traveling to the suburbs, because the logic was, well, if I'm having to work from home and I am being locked down to where I can't go out and enjoy the walkability of the city. The only reason you live in the city is because of the ease of access to everything that the city holds. The arts, the culture, the public walkways, all of the benefits of living in a city. If you're in lockdown, and most of the time if you live in New York City, your life is spent walking to the local cafe, walking to the food truck, taking the subway, doing all these things. It's not, the value of living in the city is not tied in your 800 square foot loft in Manhattan. It's tied to everything that's around you in Manhattan. It's purely the location. Yeah. And so the logic was, well, if I'm being stuck in my house, now I'm actually having to live in my house and not in the city, then I'm going to leave and I'm going to go where I can actually spread out, where I have a yard, where I could be paying, I could take a massive profit right now on my home and buy a dream residence with a huge yard, with a huge master suite and all of these amenities for much less than what I am paying right now in rent or in my mortgage note where I live in these big cities. And so that's why you saw such migration from places like New York and California and these northern big urban areas to places like Florida, like Texas, with huge sprawling amenities. And so when lockdown stopped, the necessity for those things, as life began to resume again, the necessity to move to the suburbs began to diminish. And as you see more people, more big companies calling people back to the office, it doesn't make as much sense if I have to travel an hour and a half to get to work every day to live in this bigger house in the suburbs. Well, I'm just going to go move back to the city. And so you are starting to see that. People who even left and were working remotely in Texas and Florida are en masse saying, to hell with this, I'm going back to California. I'm going back to New York City. I'm going back to the city.
Yeah, makes sense.
Yeah. And especially there was a lot of contention for political reasons that were tied into the lockdowns as well, and how these different places were handling it. And so they thought the grass was going to be greener in a place like Florida, where, I mean, you talk about a radical shift in the general ideology of an area. And obviously I'm not saying that that's the underlying most important thing, but for some people it is. Some people it's very, very important. And the grass just was not greener whenever they got to their new destination, and they figure, well, I mean, I'm like a fish out of water here.
Yeah. Makes sense. Yeah.